Hey, ladies and gentlemen, this is Ross Nelson. For those of you that I have not had the pleasure of meeting, I'm the CEO of Reddick Real Estate Network. I'm very, very, very excited to be back. I spent the last 2 weeks in Cabo on my honeymoon. So if you see me in the next day or two, I will have a tan, but it probably won't last much longer than that. So stop by the office quick if you're interested. Anyways, this is awesome. So the last 35 years, as you guys know, we really have been an industry leader in the residential real estate investing. And I've bought a number of properties through Reddick Real Estate Network in the traditional buy and hold model. The next step was really trust deeds and mortgages. I've been buying and selling trust deed mortgages for the past 3 years now, as well as Scott Pastel and Patrick Prunty, for those of you that know them. And they've done very, very well for us. Most importantly, they've been very liquid for us and allowed us to not keep a lot of money in cash because cash is expensive. So before we get started, want to jump into a brief disclaimer. So this presentation is for informational purposes only and does not constitute an offer or solicitation to sell a membership interest in any securities. If you guys are interested, we can go over that after the presentation. So today we're going to be talking about the Value Add Mortgage Fund. Now, there are different types of investment funds, and I would be willing to bet, if I was a betting man, that probably over 95% of you on this webinar tonight are invested in one or probably more of these investment funds on the screen. So your mutual funds. Your mutual funds are going to be a company that sells shares in a fund where the shares have a specific purpose of investing in a variety of stocks. Next, you have your real estate investment trust. So again, that is going to be a company who sells shares in a fund that has a specific purpose, that invests in a variety of different real estate deals. Next, you have a hedge fund. Now, hedge funds are targeted more towards high net worth individuals, $10+ million, and institutional investors, and they don't have restrictions on what they can invest in. So when you're buying shares in those types of funds, they'll have a very, very specific investment model and business plan, but that could range from restaurants to airlines to oil to gas to mortgages and trust deeds or any other investment type, arts, wines, whatever. And next you have private placements. So with private placements, they're the exact same thing as a hedge fund in that they sell shares of a fund for a variety of different investments. However, they're opened up to accredited and unaccredited investors. So the Value Add Mortgage Fund is a private placement fund. Now the investment objective. So each fund has a very specific objective. And this fund's objective is to purchase portfolios of trust deeds and mortgages. And specifically, we focus on owner-occupied, non-performing residential trust deeds and mortgages. Now, the goal for us is to keep the homeowner in the home, and we do that by contacting them and creating a mutually beneficial financial solution in which we can allow them to get their home loan current again and get them paying on it. Now, after 6 months of a loan being paid upon on time by the borrower, it's now considered a performing loan. So that performing loan can be sold at a premium on the secondary market to investors that are looking to buy and hold mortgages and trust deeds. So we really want to create a win-win here for everybody. Now, there's a couple different terms throughout the presentation tonight that we're going to go over. And I just want to get everybody on the same page. I noticed some of you guys have invested in our private money loans. Some of you have invested in real estate, and some are fairly newer and haven't invested with us yet. And I just want to make sure that everyone is on the same page. Promissory notes are the terms of the loan. So, for example, if you had a home loan, your terms might be a $100,000 loan over a 30-year period for a 5% interest rate. So the promissory note will tell you what the terms are that the borrower is borrowing money from the lender. Next, you have the mortgage and trust deed. Now, really the only difference between the mortgage and trust deed is the state in which the property is located. They both serve the same purpose. Now, that's going to be the actual instrument that if for some reason the borrower does not fulfill the terms of their loan, the lender can then foreclose on the home, which is very, very important. And then next we have tapes. So tapes are, I guess, industry terminology, slang, whatever you want to call it. And that's just a pool or a portfolio of trust deeds and mortgages. So when you're going to buy 40, 50, 60 mortgages that are in a portfolio, you would just call that a tape. So the most important thing over the last 6 years at Marsh Reddick Real Estate Network I've found are the individuals you're partnering with and your team. And hands down, the ones that I've had the best relationships with have absolutely made me the most money. And I don't think that's a real estate thing or an industry-specific thing. I just think that's with anything in life. So over the last 2 years, I have been pushing and pulling and prodding to assemble this team together, and I think we are so lucky to just have such a fabulous team. And I wanted to briefly go through the partners of the Value Add Mortgage Fund. We obviously have a number of employees as well that are performing the day-to-day tasks, but these are the individual owners of the Value Add Mortgage Fund. So Ron is overseeing all of the operations. So he's been just instrumental in buying and selling a number of businesses throughout his career. And back in the early 90s, he started to get more involved in mortgages and notes and trust deeds, and has bought and sold a lot and really has a ton of experience and will be a major backbone for the fund. Next we have Chrissy. Now, Chrissy actually worked for State Street, which is a mid-sized investment bank, got her MBA at Davis, and has worked on the institutional side in investment banking and is going to be part of our acquisitions team and valuing our portfolios. Next we have Tyler. Tyler is our token attorney and graduated from UCLA, so he is a Bruin. You can take that as a positive or negative. That's up to you depending on your sports preference. But he is just a wealth of knowledge, and we're so lucky to have him on the team. And he's going to make sure that everything is compliant on the state and federal side, as well as foreclose on properties that may deem necessary. Next is that handsome-looking guy, Ross. That's me. And I've recently become CEO of Marsh Reddick over the last 5.5 years. I've worked alongside Marshall, and just recently, Scott Pastel and myself have had the honor and privilege of purchasing the business and carrying on the last 35 years of legacy that Marshall has left. So we're very excited to carry the torch on through that. Scott's going to be handling a lot of the marketing and events. So, for example, the 108 people that are on this presentation tonight was due to Scott's hard work. And then lastly, we have Patrick. And Patrick is just, you guys will get to know him mainly because he handles our investor relations, but he's just a breath of fresh air, just such a hard worker, so intelligent. And he's the controller at Marsh Reddick, so he handles all of our private monies, investing, as well as oversees the books for our day-to-day operations. but also is going to be producing the quarterly and annual reports and making sure that you guys get your dividend paychecks for those that invest in the value-add mortgage fund. So one thing you'll have noticed, the top 3 people were not employees of Marsha Reddick Real Estate Network. They're actually employees of Main Street Capital Partners. This has just been such a solid relationship, and there's just so much good synergy because of the strengths that we play off of each other. Where Main Street Capital Partners has been in the mortgage and trust deed business for the last 2 decades and has really done an awesome job in transitioning into the non-performing note business where there is so much profit. And then for us as Marsha Reddick, we've always been in the real estate investing industry and specifically working on the investment advisory side in working with investors to make wise decisions. So that's the partnership that we have created. And with that, I was talking to a friend, and I asked him, when you think of mortgages and trust deeds, how can I best explain that to our investors, and what really describes that best? And he said, well, it's kind of simple. It's, I guess, just it's a tool of the rich. And I was like, well, what do you mean? He's like, well, you look at any skyline in any major city across the world, the #1 commonality is that all banks and financial institutions have the nicest buildings and the nicest office spaces. And the main reason for that is because they are constantly trading paper. And so you need to invest like the banks if you want to utilize the tools of the rich. So I'm kind of weird. I ask a ton of questions. I am just such a curious person, and I'm always looking at why things work and how things work. And one thing that always interested me was Bank of America, for example. They give out a lot of home loans. And I know Bank of America has a lot of money, but man, do they really have enough money to be paying out all of these home loans that they're giving out? And so I started digging into it and realized very quickly that they absolutely do not. So 85% of the loans that are originated are bought by Fannie Mae and Freddie Mac, which means that when you go and you get a loan from Wells Fargo or Bank of America or Chase or Flagstar or any other lender for that matter, they don't actually own the loans that are being originated. They simply originate them and they service them. So what you can see here is tons and tons of paper. Literally billions of dollars a day are being traded in regards to notes, mortgages, and trust deeds. So the value-add mortgage fund is simply one of those tiny, tiny little files, and we're a $5 million fund, and we make a very good profit, but we're also very, very small in the scheme of things. So that's how the back end works. So let's look at the current situation for these mortgages and trust deeds. So currently, there are $13.2 trillion in mortgage debt out there. Now, of that, 9.8 million of it is residential mortgages. That's a lot of money. But what's even more astounding to me is that currently today, or not currently today, as of Q4 of 2013, so these facts are based off the Federal Reserve. So as of Q4 2013, 8% of those residential mortgages are delinquent. And delinquent is 60 days or later in past due payments. So when you do the math on that, that actually comes out to $784 billion. Now, that's a lot of money, right? That's so much money that I would say it's hard for most of us to comprehend. So I decided to put this picture in here to give you guys a little visual on that. Now, if you look to the right of your screen for your GoToWebinar, you will see a chat box where you can put in questions. And the question that I have for you is, what is this a picture of? So I'll take a second to give you guys a couple guesses, and then I'll tell you. One was a dryer with stacks of cash. One was money laundering. No money laundering. Stacks of cash is yes, but a little bit more. Money laundering by the government. Money going down the drain. All right. So this is $1 million in cash. So when we're looking at $1 million in cash, you can see it just fits inside of your standard laundromat. So let's take a little bit larger overview at what $1 billion looks like. So here's $1 billion. Now this is just $1 billion, right? So what we're talking about right now in the current market opportunity for delinquent owner-occupied residential mortgages is 784 billion, right? So 784 of these. So let's take one further step back to kind of get a better visual of how large the opportunity is, and with the value-add mortgage fund being a $5 million fund, how small into perspective. So here's $1 trillion, right? I couldn't give you an example of exactly 784 billion. So at $1 trillion, you can see that 784 would represent roughly 78% of this. So because it's so much money at this angle, it's fairly difficult to get a true understanding of it. So we can take a look at it from a different angle. So that's a Boeing 747 sitting on a 100-yard football field and a White House. And if you look at that tiny little thing in the bottom right corner, that's a semi-truck, right? So 78% of this is the current opportunity for these non-performing owner-occupied residential mortgages. And this is the market that we're going after with these mortgages and trust deeds for the fund. So why trust deeds and mortgages? For me, I tend to be a little bit more on the conservative end. When I go to invest, my first question is capital preservation. Will I lose money, and what are the possibilities there? Then my second question is, how much money am I going to make? Now, for me, the reason I went into real estate is because it was something that I just gravitated towards and very easy to understand. So the one thing that I love about trust deeds and mortgages is that they're always secured by real estate. Now, these can be very predictable and higher returns if you understand real estate and you know how to properly value property. And then lastly, one thing that's slightly different from property and trust deeds and mortgages is that trust deeds and mortgages are very, very liquid, and they're always readily saleable. For the right price, I would be willing to say that trust deeds and mortgages are no different than cash, because someone can see the value in them and determine the revenue stream and put a dollar amount on it and wire a check, and in 24 hours, it's sold. So these three reasons are really why I am a huge fan of trust deeds and mortgages. So the purchase process. How do we acquire these trust deeds and mortgages? So it starts with a tape. So a bundle or a portfolio of trust deeds and mortgages made available by the seller. Then we can bid on them. And you can acquire an entire tape. You can't cherry pick, so to speak. You can't say, I want this loan, that loan, that loan, and that loan, but I don't want that one, that one, and that one. You can either bid on the tape or not. Now, each tape varies. And the below criteria are the main indicators that we're looking at. So they'll range between 10 and 500 trust deed mortgages per tape. They'll be split between first and seconds, and there's really no reason rhyme or reason on how that makeup is, and occasionally there will be some REOs in the tape. Total cost in regards to what the investor will pay for it ranges between $500,000 and $4 million. And in regards to cents on the dollar, it's 10 to 50 cents. So the total cost that you pay for a tape will represent between 10 and 50 cents on the dollar of the unpaid principal balance of all of the trust deeds and mortgages combined. So I'll give you an example. So today, which is a very, very exciting day, or I guess week, we put in a bid for our first tape with the Value Add Mortgage Fund. Now, the Value Add Mortgage Fund has been open for 70 days, and it's a 5-year fund. And so to acquire our first tape, we were really, really excited about it. So I wanted to walk you through that just so you could kind of get an understanding of the types of tapes that we're purchasing. So in the tape that we bought, there were 44 notes. In this particular case, all of them were second position. Obviously, all of them were delinquent because that's really where the large profit margins are. All of them were secured by a single-family home, and all of them were owner-occupied. And the 44 notes were located in 22 different states. So let's break it down a little further. Since we're in second position, it's very, very, very important to know the status of the first lien. So there were 28 first trust deeds that were currently performing. So that means that the homeowner is paying on the first trust deed. Now, immediately when you see that, that's a very, very positive sign, because what it's showing you is that the homeowner is going to want to stay in the home, which is why they're paying on it. Now, the other 16 first trust deeds were delinquent. So the next question you have to ask is, has the homeowner filed bankruptcy? And has the first lien initiated a foreclosure? Which none of them has, which was another positive. So now that we have these 44 different loans, we have to decide on an exit strategy. So there are a number of different exit strategies that we can implement in order to generate our profit from the notes we just purchased. Now, the package we just bought, we bought it at 13 cents on the dollar when you're looking at the total cost versus the total unpaid principal balance. So what we can do is we can turn around and sell it immediately at 16 cents on the dollar. And there are a lot of small mom and pop shop type investors that are looking for that type of deal. So for them, they're looking at it as we can buy these second trust deeds, and we'll break them up into smaller packages. So we may sell them in bundles of 5 or 6 notes at a time, so that a smaller investor can take advantage of. And they're looking at it as 16 cents on the dollar. This is awesome. Well, for us to make that additional 3-cent spread in a 30 to 60-day period creates a huge profit for us. The next exit strategy that we can look at is accepting a discounted payoff. Now, where this will really come into play for us are on the first trust deeds that are still performing, because this shows that those homeowners have money, but not only have money, intend on staying, which is why they've kept their first current. So for them, if we can go to them and say, you know, we will settle the second trust deed that you have for, say, 26% of your unpaid principal balance, well, because we only paid 13%, that means that over a 6-month time period, we could double our money. Now, next is the workout. So this is going to be our most common method. And the reason I had both of those bullet points come up at the same time is because what we're doing there is we're going to the homeowner and we're figuring out what happened, why they're behind on their mortgage payments. Was it a loss of job? Was it a death in the family? Can they truly not afford the home and they shouldn't have been in it in the first place? And once we figure that out, we figure out how much they can afford on a monthly basis. And because we are now the bank, and because we own that trust deed or mortgage, we can negotiate any terms that we want. So once we negotiate those terms, we can decide after 6 months, now that we have a performing loan, to sell it on the open market, or we may be able to generate a profit large enough to where we'll want to hold it for the 5-year period, the mortgage fund, and sell it 5 years from now. Now the next exit strategy would be orchestrating a short sale. So this probably wouldn't be the case on the 28 first trust deeds that are performing. So they probably are not really going to have an intention of selling the home in regards to the homeowner. But this could definitely play into the fact of the 16 first trust deeds that are delinquent. So with that said, the homeowner would basically oversee the sale of the home, and the first and second would negotiate a dollar amount that they would receive in regards to forgiving the additional loan amount. And then lastly is accepting a deed in lieu of foreclosure. So with a deed in lieu, the homeowner basically says, I'm done, I don't want to own this home anymore, I'm just willing to sign it over, and I'm going to walk away. So these are all different exit strategies that we can decide on. And then lastly, the foreclosure. Sorry. So foreclosure is they don't want to cooperate. So they don't want to deed the property over to us. And, you know, in this case, obviously, through the legal system, we will file a notice of default and go through the foreclosure process in regards to what it is for that particular state. And then we will turn around and just sell the home as an REO. So as you can see, there are many different ways to make money. And what we're really looking at is which exit strategy fits each individual note best in order to ensure that we can make the highest profit on that particular note. So I want to walk you through the life of a mortgage so that you can understand where all of these delinquent or non-performing first and second trust deeds are coming from. So here we have a lovely newly married couple dreaming of owning a home, and this is 2004. And they're going back and forth and going back and forth, and should we buy it, should we buy it? So finally, 2006 rolls around, and all their friends that bought homes back in 2004 are talking about how much money they made and how great it is, and so they finally decide, okay, 2006, we're going to pull the trigger and buy a home. So they buy the home, and the mortgage statements start coming. So they're paying their mortgages, they're continuing to put money into the home, and all of a sudden, 2008 comes along. And 2008 seems like a long time ago, but for some people it was still yesterday because they're still being affected by it, unfortunately. So 2008 comes along, and unfortunately the husband loses his job. And as purchase prices are starting to plummet, they're beginning to get in over their head, and they don't know what to do. And before you know it, 12 months later, the husband gets a new job, which he's ecstatic about, and they're able to start paying on that mortgage. The problem is their home's upside down. So now they have a $200,000 mortgage on a $100,000 home, and they begin asking themselves, why do we continue to pay this mortgage after all the struggle we've been through? The home's not even worth what we bought it for. But then they come up with an idea. They say, you know what? We can refinance. We have a 7% interest rate. We've been paying on the loan for the last 3 years now. So the loan's a little bit down, but the most important part is interest rates are now down to 4%. And if we can refinance that and get a 30-year fixed on a 4% interest rate, we're not going to have a problem continuing to pay this mortgage. So what do? They call their bank. And what does their bank say about them refinancing the loan after the husband has had a gap in employment and the home is significantly underwater? No. So now they're thinking, gosh, our home's underwater. This makes no sense. I'd rather just let the home go, buy the home next door for $80,000 less. So the foreclosure notices come. As time goes, they realize they're going to foreclose. Obviously, the best part of foreclosure or all the little birdies that are chirping around and talking about how their neighbor, can't afford their home and how they're poor at managing their money and how they have to move their kids in different schools. But all of a sudden, the value add mortgage fund comes into play. So during that time, that bank that owned that first and or second trust deed or mortgage sold it. And they sold it to the value add mortgage fund. So because we're only into it for 10 to 50 cents on the dollar, we can throw these homeowners a lifeline. And we can renegotiate those loan terms, and we can essentially refinance or reset them and put them into payments that now make sense for them, and not only keep them in the home, but make a huge profit along the way. So it's a huge win for the homeowner because they've broken free from that. They still own their home, and we've made a huge profit along the way. Now, reworking the loan, although it's our primary business model and will happen with a majority of our mortgages and trust deeds, it won't happen with all of them. Sometimes we get this guy. So it says here you're applying for a no-interest loan because you have no interest in paying it back, right? So when we come across these types of people, that's okay. We've accounted for that, and we can either short sale or foreclose on the home. So the profit margins are built in, and it just depends on the exit strategy that's implemented. So the keys to success. Being honest. I don't know why that is such a foreign concept today, unfortunately, but just being honest and completely transparent. You got to be completely honest and transparent with the hedge funds and private equity groups we're buying from. Sometimes we get tapes that come across our desk that are just absolutely awesome deals that we don't have capital for at that second. And if we're not able to perform and we tell them we are, it's going to really hurt the relationship. The other thing is just telling the homeowner and not beating around the bush. Here are the terms. This is how we can work together. And if not, it doesn't work. Being completely transparent. So we work with Daryl Kaufman, CPA, who's located in the Sacramento area, who will be doing all of the bookkeeping for the Value Add Mortgage Fund and assembling the tax returns as well as the quarterly and annual profits. Next is the relationships with the hedge funds. This is so huge, and this is where Main Street Capital has really come into play for us, is because of their tenure in the industry and the performance that they've had, they really have opened up a lot of doors to get a lot of sellers so that we can get a lot of mortgages and trust deeds. Next is the experience of the management team. We definitely have big shoes to fill in continuing the legacy that the network has had the last 35 years, but also in working with Tyler and Ron and Chrissy, it really has been a match made in heaven, and I've just really enjoyed working with those guys. And then lastly, the ability to close quickly. So because this is a $5 million fund and having the cash readily available to wire when the deals and opportunities come across is so, so important. We can't drag our feet, and we have to take advantage of the opportunities when they show themselves. So I'm going to dive into the structure of the fund, and then we will talk about the profit splits and returns of the fund. So the Value Add Mortgage Fund is a $5 million fund, which means the fund will only raise a total of $5 million. The fund has been open for 71 days now, and we're just shy of $1 million. And there are two different types of shares. There are management shares and there are investor shares. So management shares are not bought and sold. Management shares are owned by Main Street and by Marsha Reddick Real Estate Network. Investor shares are bought. So we're going to go through three different examples. So Warren B. bought $100,000 in shares. Bill G. bought $200,000 in shares. And Donald T. bought $70,000 in shares. So fund share details. So each share is $10,000, and each investor must purchase a minimum of 2 shares to become a member of the fund. Now, because it's a $5 million fund, there is a total of 500 shares, and that's it. Once the $5 million is raised, the fund is closed. Now, the fund has a 5-year lifespan. So at the end of 5 years, all profit will have been paid on a quarterly and annual basis, and all principal will at that time be paid back. So how the fund returns and profits are split. Now, this is so huge and so important. There's 1,000 ways to skin a cat when it comes to funds. And for me, the most important thing, as I had mentioned earlier, was the protection of capital, right? When we're investing, the first thing we want to figure out is, am I going to lose money? And if the answer is no, my second question is, how much money can I make? So with that said, this fund has no reoccurring annual asset management fee. Now, that is huge. So the first 8% of all profits are paid to the investor first. So there's an 8% preferred return. And I'm sure you guys can all understand that we don't work for free, right? So we're not really concerned about making 8% annually because I don't get a paycheck if we only make an 8% profit. So the 8% preferred return is distributed quarterly. Now, second is the profit share. Now, not only do I think we're going to make 8% on our money, I think we'll make significantly more than that. And with that, there's a 30% profit share, which is given to the investor, and that's distributed annually. So I want to break this down and go through an example with you. And for this example, we're going to go over Warren B., who had invested $100,000. So if you guys remember, each share is $10,000. So at 10 shares, $10,000 a share, there's a $100,000 investment. So let's say that in the first year, the fund makes an 18% profit. So if 8% immediately goes to the investor because that's their preferred return, it'll be paid out 2% per quarter. So at the end of the year, that 8% on a $100,000 investment will total $8,000. Now there's a remaining 10%, right? So with that remaining 10% profit, the investor gets 30% of it. So 30% of 10 is 3%. And if you remember, Warren B. invested $100,000. So 3% of $100,000 is $3,000. So that year, there was an 8% preferred return plus a 3% profit split, which gives you, the investor, a total of an 11% return. So because Warren B. invested $100,000, there was an $11,000 profit paid out in distributions. So now let's look at it with how will this break down over the 5-year period. So let's say that year 1, and these are all very realistic. These are not pie in the sky. We tried to be right on target with past performance and where we're at to date. So if in the first year the 11% return was made on the $100,000, that means that Warren B. would have made $11,000. The second year, 17% means that $17,000 would have been paid out to him. On the third year, Warren B. at a 25% return would have had $25,000 paid out to him. Year 4 would have had 20% return, which would have been another $20,000. And then year 5, an additional 20% return paid out, which gives another $20,000 in distributions paid out to Warren B. So over the 5-year period, there's $93,000 in income distributed as profit. Now remember, because the fund will be closed down at the end of 5 years, the initial investment will need to be returned as well. So when you break that down, and you average it over the 5 years, it comes out to an 18.6% average annual return on investment. Now, one thing about all investing is there are obviously no guarantees. So you may make less or you may make more. This is simply an example. So benefits of the fund. The biggest benefit, and really my biggest priority for the investor, was to ensure you're protected. I've got a lot of years left in me, and one thing that I have always found is that it is so much easier to continue reinvesting clients' money that is already invested with you than to try to find new investors. So for us in the fund structure, I really wanted to make sure that I protected your initial investment, and I did that by 2 ways. One, ensuring that it was secured by real estate in the form of a mortgage or trust deed, and then number 2 is paying out the first 8% of profit to the investor, which means that I don't make any money, being Marsha, Reddick, and Main Street, don't make any money until the investor is paid their first 8%. Secondly is passive income with no work. Real estate absolutely is passive income, but you have to do something. You can't just, sit on your butt. You either need to manage your property managers or manage the property yourself. I don't personally manage any of my properties. I utilize property managers. Even with property managers, you need to be involved. So this is truly, you sign an agreement and wire the money and then deposit your dividend checks. There really is no work. We do 100% of the work. Next is all assets that are purchased are secured by real estate. So at the end of the day, the worst case scenario is that we're going to have to foreclose on this property and own it. And then lastly, because there is so much work involved with non-performing loans, it just offers a huge, huge yield potential. And the profit margins are awesome, and has really been the reason that we've gotten involved in it. So how to invest. So if this presentation has intrigued you and you would like to learn more, we have a private place memorandum that goes through all of the nitty-gritty details in regards to our exact business plan, how each tape generally breaks out in regards to first trust deeds and second trust deeds, where the loan to values are, as well as financial projections for what we feel years 1 through 5 will be. And if you are interested in that, you simply just have to fill out a non-disclosure agreement. Non-disclosure agreement says, basically, I will keep this private placement private, so you can show it to those that have a fiduciary responsibility to you, like your attorney and your CPA. But other than that, you're not going to make it public and post it on LinkedIn and try to get all your friends involved in it as well. You'll keep it private. The second thing we'll need is an offeree questionnaire. And the offeree questionnaire is required by the SEC. And basically, that takes into account which investors are accredited and which investors are unaccredited that are investing into the fund. So you would send us your non-disclosure agreement and your offeree questionnaire, which obligates you to absolutely nothing. They're simply compliance requirements. And then we will send you the private place memorandum, which will have our full business plan. If in reading it you decide that this makes sense for you, you would then simply sign the agreement and write the check, and you would own shares and be a member of the fund. So how to get started and questions. So there are a lot of people on the presentation tonight, and we will absolutely do our best to get to everyone right now and allow you all to enjoy the benefit of the questions of others. If for some reason we don't get to all the questions on this call, we will get back to you by the end of this week. So if you have a real estate advisor that you're already working with, feel free to just contact them and continue working with them and tell them you saw the presentation tonight and you would like the offeree questionnaire and the non-disclosure agreement so that you can receive the private placement. If you're not working with a real estate advisor, feel free to contact my right-hand man who works here in our Newport office with us, is Patrick Prunty. And Patrick's going to be handling, as I had mentioned earlier in the presentation on the management team, he's going to be handling all the investor relations. So any questions that you guys have, sending out the quarterly reports, the annual reports, obviously ensuring you guys receive your dividends on a quarterly basis, and anything else that you guys may be curious about. Without further ado, let's start hammering out tons of questions. Also, I wanted to mention that I do have Patrick Prunty on the call, as well as Ron Hoppy. So Ron is the CEO of Main Street Capital, which I had mentioned. He's going to be the backbone of the operation and really dealing with the day-to-day in regards to the valuation of the portfolios, as well as making the loans performing. And then Patrick is going to be handling the investor relations. So if you have questions for them as well, they'll be involved in this Q&A session. Ron, you there? All right. So let's see here. So first question is, if I purchase 10 shares now and 2 years from now want to purchase more, will that be possible? Okay, so in regards to this fund, there's a 12-month capital raise. So a 12-month capital raise or the $5 million is raised. So what that means is whichever comes first. So for example, if we raise the full $5 million on the 8th month, the fund will then be closed. However, if we only raised $4 million, we already raised, if we raised $4 million and the 12-month mark comes, then the fund will be closed as well. So we're at the 70th day, so do the math, and that's when the 12-month mark will be completed. So what percent of the delinquent loans are actually viable? Denny, can you expand on that? What I'm assuming the question is asking is what percentage of the delinquent loans can we make profit on? I'm assuming that's what viable means. So with that said, I mean, we generally factor that in ahead of time, so 100% of the loans will not be profitable. There are some loans that in the bid, we will give them a value of 0 and literally will not pay the hedge fund or private equity group that we're acquiring the tape from a dollar amount, because we will write them off as a complete loss. Now, occasionally we can turn up profit out of them, but sometimes, you know, say for example, a $200,000 home has a $210,000, $220,000 first, and a $50,000 second. That's going to be not a very strong lien position, so we're not going to be willing to pay for that loan. However, we can't cherry pick necessarily in which loans we want, and so we just take in the good with the bad and value the tape as a whole to ensure that we meet the profit margins that we're expecting. So Patrick, do you want to take this one? It's a fairly broad question, but it says, what is the typical loan to values for mortgages and trust deeds?
Well, hi everyone. Thanks for being on the call. We do have a lot of questions. We'll try to get through these. And I'm not exactly sure what the question is intended, but I'll give some feedback here. So as far as the loan to value goes, you know, we're definitely buying distressed, non-performing paper. So chances are that the fair market value of the home is less than the total of the amount owed amongst all the lien holders. So with that in mind, we're most likely dealing with more than 100% loan to value. So I'm not sure if that addresses the question, but if they would like to expand, we can expand the answer.
All right, so the next question is, can an investor withdraw their investment in less than 5 years? I can take that one. So the answer to that is yes. Now, with that said, 5 years, I know a lot can happen, but it really is not necessarily considered a long-term investment at a 5-year term. So we really are looking for investors that truly want to partner with us and be in it for the full 5 years. Now, with that said, you can pull out at any time. However, there are penalties. So if you purchase shares and want to withdraw your funds in the first 12 months, there's a 20% fee. If you pull out years or months 12 through 24, there's a 10% fee, and then years months 24 to 36, there's a 5% fee. And after the 36-month mark, or 3 years, there's no fee. So if you wanted to withdraw in years 4 or years 5, there would be no penalty. But yes, you could withdraw at any time. However, we're not necessarily looking for investors that want to invest for the next 6 to 12 months. We really, would prefer that you're in for the full 5-year term. And the reason for that is after the 12-month mark, say on the 8th month we raise the full $5 million. Now the fund is closed. And then at the 18th month, let's say someone pulls out $200,000. Well, that's $200,000 less that we have to invest during that time period for the remaining of the 5 years. So it's not that we are looking to profit on people for giving them that fee or penalty and withdrawing their funds. It's just that we want to continue to invest that money for the full life of the fund.
We got another good question from John, and a number of people have asked about the tax implications of the income generated by the fund. So the fund being a California LLC, with you guys as the investors, you will become members of the fund and members of the LLC. With that said, at the end of every year, depending on how you invest, whether it's with a self-directed retirement account or just cash that you put in, or through your own LLC, whatever the actual investor is that's putting the money in will receive a K-1 at the end of every year. And then, we're not CPAs and can't give tax advice, but I can tell you that the K-1 will distribute to you a pro rata share of all of the different types of income that the fund receives.
Also, I would absolutely recommend talking to, your CPA or tax preparer in regards to any tax-related questions and how you personally will be affected in regards to the interest. But one thing I will say is I can't wait for the day that I pay $1 million in taxes. And the reason for that is because you just made a lot of money.
We had another good question. We get this pretty commonly, again, from John, talking about the percentage that go through foreclosure. So foreclosure is, something we're not afraid to do, but it's always our last option. We'll exhaust the other strategies before we get there, but percentage-wise, we're looking at between 15 and 20% of the loans that we acquire will eventually get to a stage where we are forced to foreclose. The homeowner, for some reason, we can't find them, or they just absolutely don't want to play ball, we'll get to that level.
So one question is the fund secured by the FDIC? So the FDIC only secures nationally chartered banks, and in that they only secure savings accounts. So if you're looking for an FDIC-insured investment, you're probably going to be expecting around 0.25% to maybe 0.9% on the high end if you go to like Ally, which is an online-only bank. So the answer to that is no. Outside of nationally chartered banks that are savings accounts, and with that under $250,000, no investments are FDIC insured. But good question.
I've got another good question here about Main Street and their track record. So, you know, as Ross stated earlier in the presentation, that this isn't their first rodeo. Ron had been in the business since '91, put together a fantastic team at Main Street Capital. They currently have 4 other funds with this investment premise in play. They're all closed, and they're all of different sizes and structures. But what's important to understand is that they've not failed to return the preferred return in any case. And in general, they're returning well above the preferred return.
Next question is, if I invest some money now and some money later, meaning let's say they invest $30,000 in the month of June, they will only have an additional 8 months or 9 months to invest again. Will they receive 2 separate K1s? And the answer to that is no. Each investor would receive 1 K1. I mean, if you invested from 2 different entities, so if you invested as Ross Nelson, the person, and I took money out of my savings account and say I put $50,000 into the fund, and then I also invested in Ross Nelson Self-Directed IRA LLC, that would technically be 2 separate people. One would be an entity and one would be a human, but each of those would be 2 separate investors, even though I controlled both. So in that case, there would be 2 K1s.
I got a really good question here, and I'd like to clarify about when we're going to start investing. So, you know, Ross went through the presentation pretty quickly, but it's important to know that no, we don't have to wait until we raise all $5 million. And in fact, as Ross stated, this has been a very, very exciting week for us as we've made our first investment already. Just reiterate some of the things that Ross stated about that first tape that we purchased, is that it included 44 assets. Of those 44 assets, all are second position, all are secured against single-family homes across 22 different states. So, you know, we're very excited. We're going to be looking to implement the first exit strategy, which is to sell some of those in their non-performing state to some smaller investors down the line from us that have less capital than we do. You know, we've got a good amount of $5 million, but there's many below us that don't and need to look for smaller pools that are made available by us. So with that said, we're off to the races. And we're excited about working through all of those notes that we've acquired and, of course, buying the next tape.
Yeah, absolutely. And to comment on that, so the fund has been open for 70 days now, or 71 days, I think. So with that said, we need to raise a minimum of $250,000 before we could start investing. But we raised that in, I think, like just after the first 30 days. So we have already exceeded that, which gave us the ability to begin investing the value-add mortgage fund investment money. Okay, so $5 million doesn't seem like a lot of money in the billion-dollar market. How do you expect to make a significant impact in the market? I mean, to be honest with you, we're not. I mean, we're really not going to make a significant impact in the market, but we are going to make a significant profit on the monies we invest. So the main thing that we're looking at is over the course of the 5 years, will there be enough tapes to sustain the projected return on investments that we're looking for? And if yes, then great. And we have, in seeing that, we have, decided that this makes a ton of sense. And, so we're not really trying to make an impact on the market as a whole. We're just trying to make a killer profit for our investors and ourselves. All righty. There's a lot of different questions.
Another question about investing with retirement money. That's absolutely an option. It's obviously got to be self-directed. So this is a non-traditional asset. But something like a solo 401k or self-directed IRA, absolutely. And it's definitely a good way to do it, with the income generated being tax-deferred or tax-free, depending on the type of entity you're using.
One question is, what's Marshall Reddick's return? So I'm going to walk through the return and profit split really quickly one more time. So the investor gets the first 8%, and then at the end of the year, they get a 30% profit split. We get, we as in Marshall Reddick and Main Street Capital, get the 70% profit split. So whatever is left after the 8%, we get 70% of that. And we obviously have contracts that split that between Main Street Capital. So that's how Marshall Reddick Real Estate Network makes our returns. What percentage of seconds do you expect? And what percentage of firsts do you expect? You want to take that one, Pat?
What's the question again?
What percentage of seconds do you expect, and what percentage of firsts do you expect?
Okay, so on average, we're expecting, we actually prefer second position notes. Now, a lot of people would say, oh, geez, that sounds risky. Well, there's actually mitigated risk when purchasing it in second position. But a lot definitely has to do with the status of the first position when you're buying a second position note. But to directly answer the question, we're probably looking at 80% of second position, 15% first position, and the remaining to be actually REOs where we're not buying the note. Once in a while, a part of the tape that we purchase will actually be taking the property as opposed to the note. But again, about 85% of the tapes we'll be buying will be second position, and 80 to 85, and 10 to 15 first, with the remaining being REOs.
Here's a great question. I just lost it. Okay, so the first tape of 44 assets are purchased. So if I invest tomorrow, will I not be included in those assets? Okay, this is a really detail-oriented question. I'd love for Patrick to walk through that in regards to dates that investors invest their capital in regards to when they get paid out on returns of profit.
Okay. Your end date.
Sorry about that.
So when you go through your due diligence and you filled out the non-disclosure, the offering questionnaire, you get the private placement, you decide this is for you, you write your check, you send it, we deposit it, you become a member of the LLC. I'll be working with you along with Tyler Hoppy to get you a membership certificate, and then we will determine what is called your quote-unquote in date. From that day forward, you will start to accrue your 8% preferred return. Now, we did take down our first tape. with investment money from those who have already invested with us. But those who invest after this, it's not on a per tape basis. It's based on the assets of the fund. So the faster we put in the investment capital, the quicker we can buy the next tape, the quicker we can start working through the assets in that tape, the more profit we can generate. But again, it's not by tape basis. It's based on your end date.
So here's an example. If investor 1 buys 10 shares at $100,000 and investor 2 buys 10 shares at $100,000, and investor 1 is invested for 12 months out of the year, and investor 2 is invested for 6 months out of the year, and that year they both made 10% on their money, they wouldn't get paid out $10,000 each because investor 2 was only in the fund for 6 months. So although he would make 10% on his money, he would only make 10% over a 6-month period, which is half of the other investor that would have been invested for the full 12 months.
Now, it's important to understand there, guys, that this only happens in year 1 during the capital raise. We're all going to be on the equal playing field once we get past the capital raise and into year 2, 3, and 4. So your return will just depend on the number of shares that you purchase.
Yeah. All right, we'll take 1 or 2 more questions. One is, how does this compare to buying tax liens? I mean, that's like comparing apples and oranges. I personally think tax liens are very time-consuming and do not produce predictable profits. And I haven't heard anyone make an absolute killing on them. The reason I wanted to start getting into the mortgage and trust deed industry is because of the success and because of the profits and the level, or I should say low level, of risk that was involved. So I don't know, they're kind of like apples and oranges. Like, would you prefer to own a stock or a bond? I mean, I don't know. It's very difficult to compare the two because, they're not really like.
I'm going to comment on that. One thing about a tax lien or a tax deed is that, and there's a lot of companies out there that do that. They utilize your money. They put you into an investment of that sort. Now, the end game there is ultimately if that lien doesn't redeem, then you're going to be left with the property and having to foreclose on it. Okay? So with the fund, there's no option for you to actually have to go and foreclose individually on a property. That'll never be your end game. The fund may have to go out there and foreclose and take that property back, and then the fund would sell that property. Meanwhile, you guys will just be collecting your 8% preferred return and your 30% profit share on on all the money above and beyond the 8%.
Yeah. Okay. So there are a lot more questions. We're going to wrap it up. Feel free to contact Patrick Prunty or your real estate advisor with any additional questions, and we'll be happy to provide you the prospectus on the fund with financial projections once we receive the offeree and questionnaire back.
Yeah, again, I want to thank you guys for being on the call, and just want to remind you not to delay. We've been now open for, like Ross said, just over 70 days. I'm actively working with, approximately 40 to 50 investors just like yourself who are at varying stages in their due diligence. We do have a little ways to go with the capital raise, but we're going to be having a windfall here, and I would hate for anybody interested to lose out on the opportunity to invest because they delayed and decided that they'd wait till next month or 2 months down the road.
Yeah, and this is an opportunity that I absolutely love. It's just been so cool to see how we've evolved and grown as a business, and how when we first started dabbling in mortgages and trust deeds 3 years ago, I didn't realize that it would probably represent 50% of our business over the next 10 years. And so this is really a direction that I firmly believe in, and I don't just believe in it with the actions of our business, but I've invested personally, as well as Patrick and Scott and Marshall, for that matter. So this is an awesome complement to buy and hold property, and I don't think it's meant to replace it at all. It's just a great way to diversify your net worth and to continue have your money working for you and making great profits. So I hope you guys enjoyed tonight's presentation, and I look forward to getting to know you, and have a great night.